Our top story tonight, there is no stopping the Wall Street rally. The Dow closed at a record high for a seventh day in a row at 14,455. So what are you doing about it? Where's your money right now? Today's Power Panel is here with what the average investor should be making of all this. Lance Roberts is the chief economist and CEO of Street Talk Advisors. Spencer Patton is the chief investment officer at Steelvine Investments. And you recognize Jonathan Hoenig. He is portfolio manager at capitalistpig.com and a Fox News contributor. Thanks to all three of you for joining us. Lance, let me start with you, because the average person is out there watching this and they're hearing record, record, record day after day, and they're saying, what am I missing? What are they missing?
Well, obviously they're missing the market going up, but you know, there's this kind of this assumption that the average investor has been out of the market for 3 years, 4 years now, and now they're just kind of waking up. And you know, it's not the case. Most people that are invested are no, it's not really. If you look at a lot of the data, only about 20% of Americans are actually actively involved in the market anyway, and the bulk of those are invested for the most part. So you know, they're in the markets, they're participating, and you know, the issue really becomes though is we have to look at the risk here. You know, we've obviously got the Fed inducing the markets, $85 billion a month. Right. That's driving these market prices higher. That's fine, no problem with that. But margin debt is now back at levels we haven't seen since 2007. Yeah. You've got high yield credit. High yield credit yields are at the lowest level on record, which just basically means that the yield chase and the risk is definitely there. So you just want to be a little bit more cautious about where you go to from here.
Jonathan, you know, I'm thinking of the 1 in 4 Americans who tapped in their 401k to try and pay their bills over this period of time. And I'm also thinking about the people who stopped contributing to their 401k when they saw the market tank because they got nervous about it, and now they're sort of waking back up to what's going on and seeing that they missed the ride up. What would you tell those people to do now?
Well, get out of the habit, Melissa, of making investing an all or none decision. And I think your point speaks to that exactly. I mean, go back to 2009, 2010. Investors obviously became very scared, and a lot of those individual investors, unfortunately, pulled all their money out of the market. Now we're at all-time highs in the down, and of course, you're starting to see that trickle in again. But I have to say, I disagree slightly with our guest. We have seen, especially over the last 4 to 5 years, a lot of money come out of stocks. It's gone into bonds and into gold. Yeah, and I'll tell you, although the fact the market's now been up, 9 days in a row, I think the trend still continues. I see higher prices for stocks despite the run we've had.
Spencer, do you think that the retail investor is on the sideline, and what do you think they should be doing?
Yeah, I think we've seen more retail investors in bonds more than anything. There's definitely a significant chunk still on the sideline. But I think what people really need to do is wake up to the fact that they've lost a lot of their purchasing power over the last 5 years. Gasoline is now at $4 a gallon, where it was at $2. Gold was at $750 an ounce. Now it's at $1,500. They need to get into real assets, buy things like real estate, get invested into agriculture, get into things that are going to preserve your purchasing power. Do not buy the market. Once it's up 9 consecutive days, the longest since 16 years, you will wake up and regret it in the morning. Please run and don't make that mistake again here.
Lance, is that good advice? Because, I mean, that is a good point. You've lost a lot of purchasing power. The Fed is just going to keep doing what they're doing, so it seems like that trend could continue. Do you agree with that? What advice would you give in light of that?
Well, I think it's great. You know, I actually agree with both of your guests over the last 2 points. I call this the Taylor Swift market because people treat this like a bad relationship. When it doesn't work out, they bail out right at the worst time, and then they try to get back in at the top.
Yes.
But the reality is, I agree with both. Is that look, the markets are very extended here. There is risk, and so you want to buy on corrections. And again, I agree with Jonathan. You don't want to be all out of the market or all in. It's never good. You cannot time the markets. But in respect to your second guest, Steve, who's absolutely right, it's about asset allocation. Stocks are a fine place to be when all the fundamentals are in place, but earnings are deteriorating, risk is high, and people are chasing stocks because they're going up. But look, there's some great places to put money. Bond prices have actually declined over the last couple of months, which have given good opportunities in the BBB rated space. There's also great opportunities. Gold has had a great decline over the last few months. Very, very oversold. This is the most oversold that gold has been in the last 3 years.
Wait, guys, I want to ask each of you in really plain language. If people have money sitting on the sidelines right now and they are watching this record day after day after day, would you add money to stocks right here? I'm going to go through everyone. Jonathan, you start first. Would you add money to stocks right here?
Absolutely, Melissa. The best indicator of the market is the market. So I don't believe, and as the other guests have said, I don't believe you buy on dips, buy on corrections. You never know if that correction is the beginning of something more substantial, something more serious. So no, I believe in buying strength. And right now, if you had to look at stocks, bonds, and gold, unquestionably, stocks is the best asset class to have your money in.
Oh no! Don't buy now. You will really regret it if you buy at these peaks. You do buy on corrections. That's what the data in the past has shown. Buy when things are cheap. Don't buy when it's at the very top.
Okay, I'm thoroughly confused. So Lance, you're going to be the deal breaker here, the tiebreaker. What do you think?
Look, the bottom line is that markets are very overbought. They're going to pull back at some point, maybe this summer. Buy on corrections, buy on weakness. That is when you're going to make the best opportunity. Buying now, you're guaranteed in the next 3 to 4 months, your values will be lower than they are today.
Jonathan, you're odd man out now. I'll let you have the last word and make your case.
Well, I mean, that idea of buying on corrections, Melissa, you go back to, 2007, you would have bought all the way down to a 50% correction in the Dow. I, in fact, don't see that now. The market moves in trends. That's the best indicator we have. And right now, yes, of course, the market's going to go down one day in the future. It's not going to go up forever. But I still think that it's the best asset class you can have. And I tell you, stocks are like sushi. You don't want to bargain. You don't want them on sale. By quality, by strength, trends tend to persist.
You know, what we did learn is something you learn every time there's a big stock market crash like what happened in 08, is that if you get out at that huge crash, you're always sorry later because it comes back.
Yeah.
So we do learn that in retrospect. Guys, thanks so much for coming on. We appreciate it. So moving on.